If your portfolio relies on big tech platforms for steady growth or broad market indices for stability, the baseline rules of the market completely shifted today. The United States stock market suffered a brutal and broad sell-off today, wiping out recent gains. Then we saw the Trump administration's massive rollback of greenhouse gas regulations rewrite energy cash flows. Then a direct regulatory threat hit Apple's highest margin division. Stay with me, and I will translate these massive policy and market shifts into margins and free cash flow. The entire market took a massive hit today, proving that big tech is not invincible. The tech-heavy Nasdaq composite dropped 2%. The S&P 500 slumped 1.6%, and the Dow Jones Industrial Average fell 1.3%. Investors aggressively dumped technology shares and fled to the safety of long-term Treasury bonds. People often think stock market drops are just random fluctuations in investor mood or panic selling. But a broad sell-off like today is a mechanical recalculation of the market's discount rate and risk premium. Investors are deleveraging their portfolios rapidly ahead of tomorrow's critical inflation data. If you look at the earnings path, the Magnificent Seven tech stocks led the decline because their valuations depend heavily on future earnings growth. When uncertainty spikes and inflation fears return, the mathematical denominator used to value those future tech earnings gets larger. This means investors are no longer willing to pay a premium multiple for cash flows that are 5 or 10 years away. That is how a macro fear instantly destroys billions of dollars in micro valuation. While tech valuations compress, we are seeing cash flow miracles in traditional energy. The U.S. government just abolished the foundational rules for greenhouse gas regulations. People often think deregulation just means companies avoid paying a few environmental fines. Imagine owning a massive delivery business and suddenly the government says you no longer need to buy a brand new expensive electric truck every 5 years. You just get to keep running your old, fully paid-off fleet. For traditional energy and industrial companies, strict environmental rules force massive mandatory capital expenditures. By wiping out these emission rules, that forced spending instantly disappears from the balance sheet. This is pure financial magic for shareholders. When capital expenditures drop to near zero, operating cash flow flows directly to the bottom line as free cash flow. Instead of burying cash in compliance equipment, companies can now use that exact same money to aggressively buy back their own stock or issue massive dividends. While energy companies are freed from government oversight, big tech is slamming into a massive regulatory wall. The Federal Trade Commission issued a formal warning to Apple, accusing its Apple News platform of suppressing conservative media and artificially promoting left-wing outlets. Investors usually brush off these regulatory warnings as minor political theater. They assume a $3 trillion company can easily ignore a strongly worded letter from the government. But regulation is not a simple parking ticket. It is a structural ceiling on a company's ability to extract tolls from its own digital ecosystem. Apple's hardware margins are solid, but its real valuation premium is built entirely on its services division, which commands gross margins well above 70%. If the Federal Trade Commission forces Apple to fundamentally change how it curates content, or if this opens the door to broader antitrust actions against its App Store fees, that revenue stream is severely compromised. Legal and compliance costs will surge immediately, eating straight into operating margins. More importantly, if the platform's toll booth is heavily regulated, the direct cash flowing into Apple's treasury slows down permanently. This forces the market to lower the multiple they are willing to pay for Apple's future earnings. While tech margins are under siege in the U.S., we are seeing cash flow miracles across the Atlantic. A new report shows that citizens across NATO countries are rapidly losing trust in the United States as a reliable military ally. Many think defense stocks only pop when a major conflict hits the breaking news cycle. In reality, defense companies operate like massive insurance providers for sovereign nations. When countries feel unsafe, they buy premium coverage that is locked in for decades. As European nations realize they must secure their own borders, they are drastically increasing their defense budgets. This sovereign capital flows directly across the ocean into the order books of U.S. defense contractors. This creates the absolute highest quality free cash flow in the entire market. Unlike consumer brands that have to constantly guess what shoppers will buy next quarter, defense contractors get guaranteed progress payments from governments that literally cannot go bankrupt. This perfectly shields their cash flow from consumer inflation, supply chain shocks, and economic slowdowns. At the same time, we are seeing global liquidity actively shift toward markets with highly supportive policies. The Nikkei index in Japan is currently surging. Tomorrow morning, all eyes will be on the January CPI report. Watch the core inflation number closely. If it comes in hotter than expected, today's tech sell-off will accelerate. This analysis is for educational purposes. Subscribe and join me tomorrow.